All right, I think we've officially started to record. So this is Kim Pennico, Director of Economic Justice Programming for the National Network to End Domestic Violence. I want to thank everybody for joining us today for this important topic of microlending to build and repair credit. We've been hearing from a lot of folks that they are wanting to get started in this work and see the benefits of microlending for the sole purpose of building and repairing credit. And so we're excited about what this can mean for survivors as well as programs doing economic justice and financial empowerment work. So many folks we've heard they want to do it. They're just not quite sure how it works and how to partner with people and with other lending organizations to do it in a thoughtful and ethical way. So we thought this might be helpful to give a couple of examples of how this has been done and is being done elsewhere, and also some potential partners in the work, for example, Credit Builders Alliance. So I am thrilled today to be joined by Andrea Miller from the Kentucky Coalition Against Domestic Violence and Elizabeth Johnson from Credit Builders Alliance. Both of these women have stepped up any and every time we've asked them to assist us in doing this work and provide training and technical assistance to others. They are amazing partners in financial empowerment and economic justice work. So it's a real privilege and treat to be joined by them today. We're going to start with Andrea, who's going to talk a little bit about what Kentucky's done in the microloan program, how they handle repayment policies, and some of the outcomes that they've seen. And then Elizabeth is going to follow it up from Credit Builders Alliance, talking about how to negotiate compassionate loan terms and as well as what CBA can offer. So we're super excited. So with that, I'm going to pull up Kentucky's screen, and I'm going to give Andrea Miller the floor. The floor is yours, Andrea.
Great. Hopefully everybody can hear me okay. I've got a little bit of sinus stuff going on, so I hope my voice comes across really well. Again, I'm Andrea Miller with the Kentucky Coalition Against Domestic Violence. I'm the director of the Economic Empowerment Program here in Kentucky. And basically, I've just put together a few slides that kind of talks about our program, and then we'll focus mostly on the microloan segment of that. And I just always like to start with our mission that, you know, our mission is to mobilize and support member programs and allies to end partner violence. Well, we also recognize, and Kim is certainly the expert in this, that a lot of our survivors that come through our programs are victims or survivors of economic abuse. And so that's why we do what we do. That's that number one indicator of why people are going back into relationships, typically financial reasons. So we started our economic empowerment work with an AFI grant in 2004, and we've been participating in the AFI program since then, running grant after grant after grant. We are in grants 4 and 5 because we named them so originally, 1, 2, 3, 4, and 5. That's where we are right now. We've got some asset purchases completed, 458 completed, and 202 people are currently enrolled in those federally funded grants through Assets for Independence. And we also, thanks to the Allstate Foundation, were able to start a car IDA program because we recognize that a lot of our survivors weren't necessarily ready for that classic program, which focuses on homeownership, small business, or post-secondary education. What they really needed was transportation. We're a very rural state. There's really, in my opinion, only one area in Kentucky that has a really good public transit system. The rest of the state, very rural, and it's hard for people to get to and from jobs and school without a vehicle. So that was the reasoning behind it, and then we hoped that once they were able to get transportation in place for their families, that they could transition into that classic IDA program, and we have seen that to be, in fact, what is happening. With the car IDA, we have 114 of those that have completed purchases. We're very excited, and 75 people are right now enrolled to participate in vehicle ownership. As a part of those asset building tools, we saw that credit was often something that kept people from being successful with their asset purchases, or at least that was something they definitely needed to look at before they could do their asset purchase. We found this to be particularly true with home ownership because people needed to get a home loan. And when their credit was not good, they were not able to reach that lending product. So we recognized the need for credit building, and we started to think about what can we do, what kind of program could we start that would help our survivors with this, besides just the financial education of what is involved with the lending process. So we decided to start a microloan program that would help people to build their credit, establish credit, and once they're working on the other things that are on their credit report, this is another tool that would help them with that open active trade line to help improve credit to the extent that they'd be able to access traditional lending. And we started that in 2013 with basically a small grant from Republic Bank that's here in our area. It's an unsecured loan. So the person fills out an application, we review the application, and then we issue that loan. We capped the loans at $500 for our DV programs. And let me just share that we have a partnership with our community college system. So we have KCTCS, that's the community college system in Kentucky. We have loans coming from that population, and then we have loans coming from our KCADV member programs. With the KCTCS student population, we actually capped those loans at $300, and this was just for the purpose of the grant funds. So right now, and I'm sorry if it sounds rambly, we have the Republic-funded microloans, and we also have loans funded through a Kellogg grant, Kellogg Foundation, for the KCTCS students in particular. For both of those loans, it's a 12-month repayment period with a 0% interest. And we report the payments, thanks to Credit Builders Alliance, through their reporting platforms. We are reporting to all 3 bureaus now, which is very exciting. And we are seeing definitely some score increases for people who are participating in that and paying on time. With our KCADV member programs, we have 32 loans that are open right now, and 12 have paid to term. And so they have about a year, and when you start any new program, it's a little slow sometimes to get started. So we're hoping that we'll be able to say that, yes, everybody who takes out a loan repays it, but we know that that's not realistic. With the KCTCS students, because they came into this project later, they actually took off with the numbers. We have 44 open loans right now, but only a year has gone by, so only the ones who first enrolled when we first started it have repaid at this point. With the loans also, what we did before we started our program is that we had an advisory board that was made up of advocates and survivors who had accessed our other economic empowerment programs. And we asked them about that loan cap, what would be a good number, and some of the other things that we've incorporated into our program. So again, we have the loan cap, we have the 12-month repayment period, we report the payments per our agreement with Credit Builders Alliance. The one thing that we don't do is if someone does not repay their loan, we don't pursue them for collection, but because of our agreement, we do report that loan as a charge-off on their credit report. Let's see, what do we want to say? What we've discovered with some of the challenges since we started the program, a lot of people started out getting the loans payable to themselves, and we found that those were that we actually found paying the vendors directly to be more successful for us for some reason. I'm not sure exactly why that would be, but we have just instituted a preference, if you want to call it that. It's not policy, but we encourage our survivors to have when they fill out their application, they indicate what they want to use that loan for. And we encourage them to pay vendors directly with their loan money. And then we also set up a direct payment option for them to come straight out of payroll. And that's been very helpful too with our repayment rate. That repayment rate for us, it ranges. We track it monthly. It's been as low in a month as like 30% of people repaying, so making an on-time payment. And then it's been as high as 90% of the people participating in that particular month making an on-time payment. And then we have our advocates very strongly, very closely work with the persons that are in the program to encourage that on-time repayment, because that's the key to build the credit score is the on-time payment. And when we've done these two things, which is, again, paying vendors directly and then the person pays us through their payroll debit, we found that to be very, very helpful in improving our program. People seem to like that better, what comes out of their paycheck. They don't seem to miss as much as if they have to write a check or a money order. And for a lot of clients whose schedules are very busy, that sometimes was where the ball got dropped, and a payment would come in late simply because someone couldn't get it in the mail here fast enough. We also have to work with our advocates on our application. Part of our application process is for the person who is applying for the loan to submit a budget that shows that they have been looking at their expenses, they know where their money is going, and they have the means to repay this loan. We didn't want anyone to apply for this loan and then not be able to repay it. So we wanted them to be really critically thinking about, is this a good time for me for this? Can I do this on-time repayment? Because we didn't want them to be set up for failing. And that's been a little bit of a challenge. What we found is that people actually weren't tracking their spending very well themselves first, and it seemed like, well, this is just a way for me to get money into my house right now. And we didn't want this product to be treated as an emergency request or something along those lines. We certainly want to discourage payday lending, which is where often people go for that emergency. But we wanted them to really, again, critically think about their ability to repay the loan on time, and were they able to do that. And then I know that Elizabeth is going to talk more about this, but we also encouraged people, if they got into a difficult situation, for example, maybe their hours got cut at work, or maybe they lost their job, or something else along those lines happened that impacted their ability to repay on time, what we wanted was a way to help them to stay on track or get back on track. So I know Elizabeth is going to talk about some of those options, but for us it meant renegotiating the term of the loan. So maybe they have a little bit of a deferment in that loan process where we kind of hold those payments until they're able to get back on track. And that was an option through Credit Builders Alliance, and we really found that to be very helpful for folks as well. Don't have anything else to say on that, but just some strategies that we found to be helpful is making sure that all of our advocates were using the client-centered approaches and making sure that this service in particular was the best option for that client, that was really what was going to work best for them with their needs. And then with our community partners in financial ed, we require financial ed as part of all of our economic empowerment projects. I mean, we don't want to duplicate things, so if there was like for example, bank-on communities in our area, if they were doing financial ed, we would often send folks there so that our advocates weren't having to do everything themselves. And we also wanted to make sure that we had a lot of training set up for our staff. So we have done in-person trainings, conference call trainings with our staff to talk about this product, the intent of this product, again, for credit building and for helping someone to establish credit if they've not had that before. And we wanted our staff to understand what that was like as well, so that they fully understood the process and the thinking so they could frame that message to the client. And then we have, again, that diversity of the funding sources with this product. So we've got a few banks actually involved. We started with Republic, and we still are working with them, but we have a couple others. And we also have the Kellogg Foundation money that we use for the KCTCS project. And that's pretty much how we run the program. I'm glad to take any questions from anybody at the end, if there are any in specific, or you can contact me directly.
Wonderful. Thank you so much. And there's a chance to type any questions at the bottom. And the first question we actually have in this model, KCADB itself acted as the lender rather than another financial institution. That's the question. They're asking if you're the lender.
That is correct. And I've used this phrase before many times when I've talked about this program. We consider ourselves to be the friendliest lender that anyone would ever come in contact with, because we really, really want them to be successful. So we typically don't call ourselves a lender, but we really are in this particular model. We are the ones lending the money out. We are the ones attempting to get the money back. But we're very friendly about that process.
So given that, what is the role then of a public bank? Are they just the holder, the account holder then, or that's the financial institution where the money goes through?
They granted the money to us, and it was for this purpose. So when we wrote the grant to them, we said, here's what we'd like to do with this. And they were, we've done a lot of tax work with them before, so we had an existing relationship, and it was an interest of theirs, I think. So they were very supportive in funding the project.
And have you seen folks that have participated in your program now being able to participate in more traditional lending because of the improved credit score?
Yes. We've had people that have increased their scores by 70 points, even up to 120 points. And when they're able to do that, then they can, if they are also in an IDA, which a lot of them are, at that point they may be looking at their home ownership, getting their score up for home ownership.
And if they participate multiple times and get multiple loans? I mean, after they paid one, get another one until they get their score up to where they want, so they can be a more traditional borrower?
Yes, we have 3 people that are doing that right now. They have taken. They're from our member programs actually in the homeownership IDA, and so they've had 2. One, she's working on her second. All of them are actually working on their second loan right now, and they are allowed to do that once they repay that first loan, obviously, and then it just basically gives them a history of paying an active trade line on time, which is helpful.
Right, that makes sense. And so another question is, did you provide a lump sum? And I assume the question is, they're asking the loan, the original loan's a lump sum, correct?
It is. We've had people that have taken when we first started again, we were paying, we would give that lump sum to the client directly. And then when we started with the auto payments, we would give it to the advocate. We would give the check to the advocate. The advocate would sit with the client, get the payment through auto payment set up, and then release the check to the client. And then with the payment of the vendors directly, we started to just, send us what you want paid, and we'll write the checks, and we'll either mail them to you to take to that particular person that the vendor you're trying to pay, or we'll mail it directly to them if you prefer. You just have to tell us which way you want us to handle that.
Right. So the survivor has the choice. They can take a loan out and have themselves as a payee, or they can, but you strongly encourage them to have them identify the vendor and you pay the vendor directly for the loan.
Yes, we do. Again, we're really trying to work through that client-centered process, and we just don't want people to ask for the loan. There are people who take out a loan to do an emergency savings account, and that's great. And there are people who will take out the loan to pay things on their credit report, which is also phenomenal because then you get a double benefit. You're paying off a collection and you're also getting an open active trade line. Mm-hmm. And that's been really successful. What we don't want to encourage is that the lending for things that should be built into a budget.
So for day-to-day expenses.
Yes, we're really trying to put working on that budgeting process and living within your means and making sure that this is a good program. That's our primary focus.
Something we could all learn to do.
Yeah, so we just want people to start trying to finance Christmas and birthdays. And I know that makes me sound judgmental, but we really want to encourage people to think responsibly about their lending. And that's what we're doing.
Yeah. So another question is, what obstacles or lessons did you learn?
Well, the one about having people have an option to have repayment set as a direct debit from their payroll. We actually had people ask us for that, and at first we weren't set up to do that. And we have found that that's actually improved. Again, when the people have a small loan payment, because again, these are small loans, $300 to $500, capped at $500. So it's like a $41.67 payment. For that higher end, for our KCGCS students, their loans are capped at $300. So their payroll, they get paid twice a month. It's $12.50 per pay period to pay your payment for that loan. And they love it because they're not even really missing that money. But it was a little bit of a struggle if they had to write a check. Some of them didn't have checks. And they had those debit cards. that come through the college. So we wanted an option for them to be able to conveniently and easily repay, and that was it, payroll deduction. And when we saw it was successful with the college population, we're like, well, why don't we just do this as an option for our DV programs as well? And that's what we've been doing. So they'll set it up either to come directly out of their bank account or, again, from their payroll deduction as well. And so then our accounting staff here has an account set up that those go into with a code that is identifiable as that person, and then we can apply the loans. One of the struggles that we had is making sure that we're tracking that well, because we've had to, and Elizabeth can talk about this, if we find that we reported someone incorrectly as being late, we have to go back and fix that and change that for them because we are responsible for reporting them as late, and they weren't late, so we need to fix that. And Credit Builders makes that very easy for us to be able to do that.
Very good. So another question was, what lessons have you learned in supporting staff to embrace this project? Has there been any pushback or staff sort of saying this is too much?
From our DV
not what we do.
Yeah, from our DV program staff, I think anyone that's working in this field, if you have folks working in shelter, they'll sometimes say that we don't need this, we don't need to know about this. But the reality is that people do. People need, and so we kind of try and frame our message that what we're trying to do here is help survivors achieve their goals and be financially independent. This is a tool that can help someone to do that and can help someone to settle some of the financial difficulties that they might be having. And so we try to get our advocates to frame messages that way, as in this is a tool that can help your client, but your client has to know about it. And so I guess the biggest push is ensuring that our advocate staff at the shelter level is aware that they are aware that these programs are here and available.
Well, and I'll also say, as a sort of an outsider seeing how Kentucky's done this work, you've long been a pioneer in economic justice and financial empowerment work in the field. So you all have worked on this for over a decade now. So this is not new to your advocates in Kentucky, the idea of doing financial empowerment work. So I think that's helped a lot. But I think that, and correct me if I'm wrong, that just sort of creating the space to talk about the importance of financial empowerment work in general makes this a perfect fit into that. If you're not making the connection between women's long-term safety and security and economic justice and getting and staying safe from domestic violence to this, then this does feel like an extra add-on. But if you get the connection, then this is, of course, part of the work. This is what makes our work easier.
Yes, you're absolutely right. We, again, have some advocates who've been doing this just as long as this program has existed. And then, for newer ones coming in, which happens, there's staff turnover. On our end at the KCADV, at the coalition level, we're trying to make sure that those advocates make that link, that they make that connection, that they understand that connection, and we do trainings for our advocates. We send them to training, and we do trainings ourselves as frequently as possible for them about the program and the benefits of the program.
Great. So one other question here is, and you talked about it, I think, at the beginning, but if you could talk just a little bit about the community college program partnership that you have and what that has to do with this.
Yeah, so we found in our AFI work, our IDA work, that a lot of our successful
AFI is Assets for Independence. It's a federal program.
Sorry, I tend to talk in acronyms, even though I tell people not to do that myself. So yes, Assets for Independence. With that, with the Individual Development Account program, we found that a lot of the successful persons in that program at the shelter level in particular were students at the community college in what's called, most of them were in what we here in Kentucky, it's a Ready to Work program, which our community college system has a partnership with the Department for Community-Based Services, or DCBS. And so what we found is those Ready to Work students, who were basically students who were going to college and receiving KTAP, which is Kentucky's welfare program. They were receiving the TANF, the Temporary Assistance for Needy Families, that's the federal name. They were receiving that, and they were also working on the college campus through this work-study partnership that our community colleges had. So we began to approach the community college about a potential partnership with them to be able to reach those students, because also what we found is not everyone was coming. Not everyone comes into shelter, obviously, and we thought perhaps they might have, it might be a way for us to reach more survivors by approaching this community college partnership. Well, we found that to be very true. We have an evaluation going on right now with this partnership and with our domestic violence programs of our economic empowerment project. And what we found on the community college side in particular was among those ready-to-work students, there is a domestic violence history for about 73% of those students who are participating in that survey. 73%. That's substantial. People who are reporting history of domestic violence. And 35% of those students, that same 73%, were saying this incident, their domestic violence incident, had at least one incident in the last 12 months. Most of them had not approached shelter or contacted shelter about services they could receive as an outreach client for domestic violence. So we have found the partnership to be invaluable in being able to reach more survivors and help them to succeed in, they're all using it for education, but we also have put out some of the other products for some of those folks, like our CAR program, like the Classic IDA. And so part of that KCTCS partnership is an IDA for some of the students who want to participate, and they are using it for post-secondary education. The college likes the program because it helps the students, it helps them with their retention. And that's the end result that we're hoping to see, that we can show an increase in college retention and that we can show less student borrowing and default rates by that as well. Hope I have answered that well enough for you.
I think so. Makes sense to me. So thanks so much. If there's any other questions for Andrea before I let her go and move on to Elizabeth, just type it at the bottom and we'll all be here at the end too so we can catch them at the end. So with that being said, I'm going to move over to Elizabeth's slide and I'm going to take the floor back and then hand the floor over to Elizabeth. Elizabeth, the floor is yours.
Thank you so much, and thank you everybody for joining us today. I'm really glad to be able to talk to you a little bit about how to make these kinds of programs as effective as possible for your borrowers, making sure that, as Andrea mentioned earlier, being the nicest lender anybody will ever have met, as well as what really goes into setting up to report a microloan fund. Before we get into this too far, I just want to quickly define credit building. So we actually try to stay away from the phrase credit repair, and we like to focus on specifically credit building, which means establishing and maintaining active trade lines like an installment loan that gets reported by the lender to the major credit bureaus. We see this as a way to focus on what that individual is doing right now and how that can actually connect and build toward those future goals. So just confirming what an active trade line is, here we're really looking at installment loans. So to be active, it needs to have a balance and a monthly payment and it not be closed. And part of the credit building process we see is that it's not just about having one loan, but it's about how do you have that loan and then leverage that for something more so that you're still building active credit. But that is a conversation for another day, and I don't want to get too bogged down in this. So in terms of being that nicest lender that anybody's ever going to meet, everybody's got the goal to build credit by reporting on-time payments. But we all know that reality is that life happens. People lose their jobs. They have car repairs that they need to be able to pay that may be for them more pressing than this microloan. But the good news is that in terms of the credit reporting process, the reporting can actually be very flexible and can actually be quite friendly for your borrowers even when they are having difficulties. So one thing to think about in terms of how you might consider some of the components of your loan is what the due date is. So the way the credit reporting works is that you would report the status as of the end of the month. And in the current reporting language, it doesn't care if you are 5 days late. It only cares if you are 30 or more days past the due date. So anything less, if you're 29 days past due when it's time to report, then you will still be showing up as current. So if we're talking about due dates, if we, there's the common example we see, due dates are the first of the calendar month, and so by the end of the month, if the month has 31 days, then that means that same month that individual will report as 30 days past due. And before I go any further, I do just want to interject that I'm not providing legal advice. Any loan structures, I would suggest definitely talking with some legal resources. So just covering myself there. But if you have a due date that is actually the 15th of the month, then by the end of the month, even if somebody misses that payment, they're still less than 30 days past due. So that actually gives you some additional time to work with somebody to help them get back on track. And that's why we always like to be sure folks are thinking about working with the borrower as early as possible when there may be signs of trouble. So if you have to report somebody to the bureaus at their 30-day past due mark, then that gives you a full 30-day window to start working with them and identifying some new solution so that you can hopefully keep reporting them as current on the loan. You can do things like setting new terms, and I'll have some examples of that in a moment. You can reduce payments, you can suspend them, but so long as they're current on whatever the agreement is in place, then you can report them as current and paying as agreed. So that way they can still build their credit history even if they're having a little bit of a rocky time. So some examples that we see among our members who are providing all sorts of loans, there's lots of ways that you can work with them. So for example, you could move a single payment to the end of the loan. So you just sort of extend that loan, but when the borrower is paying, they are paying the same regular amount. Additionally, you can defer payments for a few months. And again, this is going to stretch out the term of the loan. But if they know that they're not going to be able to make payments at all, if they're working with you and you can agree to defer payments for a little while, then again, they're still paying as agreed. You can reduce the monthly payment and extend the term. These can all be flexible so long as you've been able to work with this borrower and make an update to your agreement. Then you can report them as paying as agreed. And so that way, again, we're able to take the most, make the most out of this process and help people really build lots of good, beautiful, and pristine credit history, which they can then use to achieve many of their goals. So what if the worst happens? Andrea mentioned a couple scenarios and things that they have in place for when somebody has difficulties. But that brings up lots of questions. There are, again, some flexibility. There is some flexibility within the credit reporting system. So how are you managing your security or your guarantee for these loans? I know, if someone is not working with you, if they're not able to make a new agreement with you, and they really are not paying on that loan, then we do need to be sure that we're reporting to the credit bureaus in a fair way so that the people who are making their payments on time are getting the credit for that, And as much as we don't want to hurt anybody, if they're unable to work with you, sort of to what extent are we willing to let the account report as delinquent? On a monthly basis, it does not show who is paying that monthly loan payment. But if the borrower defaults, then you can decide what your requirements are and what your agreements are going to look like. But if the borrower does default and you have collateral, like maybe you have the IDA savings held as collateral for the loan, or you have a guarantor who can cover that loan in the event that the first borrower is unable to make their payments, you can report it as paid and closed, but paid from that collateral or that guarantor rather than a charge-off. So there's different ways that you can really think about how you're structuring your agreements with your borrowers to make them as flexible as possible. So now that we've got the fun stuff out of the way, CBA, we're happy to provide lots of different services to our members. We have over 175 members who are reporting through us on a monthly basis to the National Credit Bureaus. And that represents most recently over 31,000 loans made by our nonprofit members. All total, that represents over $845 million worth of loans extended to low-income individuals. So we manage all that through our CBA reporter service. For our members who are doing business loans, we also have a similar service for reporting to the commercial bureaus. Additionally, we have our CBA Access service, which allows nonprofits to access low-cost credit reports from TransUnion or Experian to be able to use both in underwriting a loan, but also in financial counseling, so you can sit down and have a clear assessment of what that individual's credit needs and hurdles might be, so that you can really make an accurate plan for them. You can also pull credit reports to see how somebody's making progress. So if you're working with someone specifically toward a goal of perhaps home ownership, then being able to access a credit score is going to give them a really great sense of exactly how far they have to go before they're going to be able to qualify for the mortgage that they need. Additionally, our most recent service is our CBA Rent Reporter, where we're working with affordable housing agencies to get rent payments reported on consumer credit reports. So that's what CBA does. We also provide consulting and training for nonprofits that may need it. And just to zoom in a little bit more on our reporter service, which is how groups like KCADV, I apologize, it's still stuck in my brain as KDVA, but for KCADV, we work with them to set up with the credit bureaus. We provide a lot of hand-holding through the process with the bureaus. We provide technical assistance throughout, and particularly in setting up the software that's going to be necessary to report that data to the bureaus. On a monthly basis, we're answering questions and identifying how things might need to be adjusted. If there's been an error, we work with them. We have several different kinds of tools to be able to correct it. Because the great thing about the system is that it's been built recognizing that human beings are actually putting the data in, and human beings can make errors. So there's always a way to fix something. In order to really set up for a successful implementation of this service, there's certain key components that we want to be sure everybody has, so that we don't have to waste anybody's time or have any surprises that we'd rather not see. For our particular partnership, we do need to verify that you're a nonprofit, that you're committed to credit building as part of your mission, We also want to be sure that you're really going to be in a spot where you are going to be able to manage this long term. Credit reporting is not a once and done, we don't have to worry about it again. We do want to be sure that you're going to be able to submit that data on a consistent basis, make sure that you're going to be able to keep accurate records, and that you have staff who are going to be able to actually implement this. And one issue that's come up previously specific to groups serving survivors is this question of established program and office space. So to set up to report with the credit bureaus, there is a credentialing process. They want to be sure that they know who you say you, they know who you, they know that you are who you say you are. You're doing what you say you're doing. You're going to be able to use the information compliantly, and that you're going to be able to have secure means of storing your information that you're reporting to them, as well as what they're selling back to you. And part of this involves a physical site visit. So they actually send somebody out to knock on the door and make sure that everything matches up and that they can see some basic security measures in place, like lockable doors and things like that. But that location has to be something that is publicly listable and can be shared with that site inspector. So we definitely want to be sure that that's going to be an address that can be safely shared, that's not going to put anybody at risk. Many of our groups have a separately located administrative office to be able to provide that specific kind of address. And it's where they are able to store their files and things like that that are specific to the loan program. Data security and compliance is, as I mentioned with the site visit, they just want to be sure that you're going to be able to manage this very sensitive and highly regulated data. We want to be sure that staff time is going to be available both for the setup phase, which is generally the most intense, as well as long term. So do you have somebody who's going to be able to really help dig in to set this up? And do you have somebody who's going to be the contact person reliably so that we can, if we have questions about the file you sent, if we get a dispute from a consumer, anything like that, that we'll be sure that we have someone that we can go to directly. There's some supporting documentation that goes along with this application, so things like some letter from recent funders, copy of your 501c3 letter from the IRS, and things like that. Additionally, if you are required to have a lending license, we need to see that or find the exemption that you fall under your state law. And Metro 2 compliance software is often a big piece of the puzzle. I'm happy to talk with anybody offline about what might work for them. We've seen how a lot of our members have been able to use different kinds of systems. We've seen the good, the bad, and the ugly. So we're happy to help you brainstorm and connect you with some options out there that might work. Because this is a kind of report that not all programs can do. Excel can't create a Metro 2 formatted file. So we need to be sure that we can get you connected with something that's going to do what you need to do. One of the really great things we're excited about that we just started this year is our rapid response team, where we've received some incredible funding from the MetLife Foundation that will allow us to send an experienced reporter to your site to walk you through actually setting up your technology to report to generate that Metro 2 file, as well as they can go over with you all of the important regulations and compliance components from the FCRA. So what do you need to do? What might you need to implement? How do we make sure that you're going to be in good standing? They'll also be able to review things like consumer dispute processes, how that works, how CBA can support you through that, and much more as well. If you have specific concerns, we can have the trainer sit down with you and go through those items with you so that you know what you're doing, you're comfortable with what you're doing, and that you have as many resources as you need to really be successful. And these visits are at no cost thanks to MetLife. All we want to do is just ask if you can bring in some friends to listen to the presentation about the FCRA compliance so they can understand what's really going to be involved in setting up to report if that's something they pursue as well. Additionally, CBA has some wonderful resources for our members. We record our webinars and post them there, so anything that our members missed, we have specific tutorials, most of them related to reporting your data. We have articles and tip sheets, all sorts of things. And we have some of these items are also available for the public. So there's lots of good things on our website because we want to share all of the great innovations and solutions that our members have been able to identify out in the field. We have a fantastic Credit Builder community. We have almost 500 members all across the country, and they are working with a variety of communities, and being able to connect with other practitioners can be a great way to ask questions and get some ideas of how you can respond to any specific questions from your clients. So if you're interested in learning more about Credit Builders Alliance, we have a very simple to remember website. It's www.creditbuildersalliance.org. And you can also contact us at membership@creditbuildersalliance.org. That will connect you with one of our team members over here who can walk you through all of the more specific requirements if reporting your loans is something you're ready to start looking at right now. All right, and with that, I think we're ready to answer any questions that might have come in, or I'll just be happy to hand it back over to Kim.
Fantastic. Thank you so much, Elizabeth. And I'll just sort of start off by saying I think it was Dara who reached out a couple of years ago to us sort of identifying that they felt like they had something to offer. CBA had something to offer NNEDV. And at the time, I kind of didn't get it. I didn't get what CBA was and how it was beneficial. So it's taken me a while to wrap my head around the benefits of CBA and understanding how critical and helpful they are to those who want to do credit building for survivors. So this is a wonderful way to do that, and Kentucky caught on long before we did and has been partnering with them for a while now, and we've got a couple other coalitions and local programs that are already doing this. You do have to buy into the program. It's a one-time setup cost, and if I over or understate it, please tell me. But then it's just an annual sort of renewal after that. So there's some upfront costs that are actually pretty minimal, right around $500. Correct me if I'm wrong. And then, like I said, a maintenance annual fee. But with that comes technical assistance. It comes site visits. It comes if you have problems, you call them. For what you get from it, it's priceless. Certainly if you're getting Allstate funds or thinking about applying for Allstate funds, that's something that can be covered with Allstate funds. We're reaching out to some possible other microlending partners. That would be included in what would be an allowable expense. But as far as an upfront cost, it's pretty minimal given what it can provide to your program and survivors. So with that being said, if there's any questions, please post those on the chat box down below. Andrea, if you have anything to add, or Elizabeth, now would be a good time.
Thanks. I actually just want to make a couple corrections in terms of the fees, just so that everybody just sort of has it on the radar.
Please
do. We do require that anybody signing up be a CBA member. Membership is just $315 a year, but we knock it down to $295 if you pay it on time. And that gets everybody in your organization access to all of our resources on our website, access to our monthly member exclusive webinars where we'll bring in some of our members to share their innovations, industry partners, as well as doing, for example, yesterday I led a webinar about the technical specifics of reporting borrower ID information to the credit bureaus. And everybody gets covered under that. The setup cost for for Reporter is actually now $750 because we've been able to add in reporting to Equifax as well. And annual renewals for the Reporter service, unless you have more than 50 loans, it's just $550 annually. So, and as Kim mentioned, there is a lot of bang for the buck. We provide lots of technical support, both in the beginning as well as ongoing. And with that, I will happily shut up and let somebody else talk.
No, I appreciate that. Thanks for correcting me. And my information is old, obviously. And we're also trying to figure out maybe if there's any way NNEDB can be a member of CBA and take some of that on, if that's a possibility. So we're thinking through some of those possibilities. We're not there yet, but I encourage you all to give it some thought. I think for what you get out of it, it's certainly worth it. And you could also build some of those costs pretty minimally into your loans. You could do a very small low interest, 1% or a one-time $5 setup fee that would help go towards some of those costs. So something to consider. Seeing no other questions posted at the bottom of the chat section, and given that we're approaching the hour's time, I think we'll go ahead and close for now. I want to thank both of you for the work that you do and for taking the time out to share it with us. I really see this as one of the things we can do for survivors that has the best ability for them to have long-term security. I always say that economic justice helps survivors move from short-term safety to long-term security. And we can give them shelter for 30 days or 60 days, and we can provide them food. But if we can't help her financially get the resources she needs to stay on her own and to help support her and her children, then we've just thrown her back into the cycle potentially. So thank you so much. I think everybody's sort of ready to sign off as well. So I am going to close out and